Okay, back for part 2 of chapter 18. We're going to start by looking at this managerial reporting and the typical manufacturing costs that companies are going to have. So I said we're going to break them down in a little more detail of what each of these are. We can see here that 45% are direct materials, 15% typically goes to direct labor, and then 40% is factory overhead. So manufacturing activities differ from both merchandising and service companies that we've looked at before. So the main difference between merchandising and manufacturing companies is that the merchandisers buy goods that are ready for sale, while the manufacturers produce goods from materials and labor. So Amazon.com is an example of a merchandising company. It buys and sells goods without physically changing them. They're not producing the goods. They're just buying it, a finished product, and selling it. Nike, on the other hand, is a manufacturer. They produce shoes, apparel, accessories. So it purchases that raw materials like leather, cloth, dye, rubber, glue, laces, and then it uses the employees' labor to convert these materials into finished products. So let's look at each of the detail for starting with direct materials. So direct materials are the actual materials that are used in making the goods. So they give example here of the steel that's used in the frame of a mountain bike. So the steel is the direct material. So direct materials are going to be the tangible component of a finished product. So when we think about direct material costs, those are the expenses we have for direct materials that are separately and readily traced through the manufacturing process all the way to finished goods. So if we think about this example of a mountain bike that we'll use throughout, it's going to be the tires, the seat, the frame, pedals, brakes, cables, gears, handlebars. Those are all examples of direct materials that are going to be used to make this mountain bike. Now we look at direct labor. That's going to be the labor that's put in by the employees who are physically making the product. So the finished product, who is involved in that process as we go along. So it's going to be the wages and salaries for the direct labor that again are separately and readily traced through the manufacturing process all the way to finished goods. So when we think about this, the operators that are involved in converting the raw materials into finished products. So it might be welding, it might be painting, it could be forming, and then also the assembly workers who are attaching the materials together, such as putting the tires on the frame or the seat into the frame, the pedals and the cables into the operation to make the wheels spin. So all of those go in to the process, and those are all considered direct labor because you can easily trace who does what in that process. Now the things that are not easily traceable or not directly traceable, that's going to fall under factory overhead. Sometimes this is also called manufacturing overhead. They're the same thing. So the term factory overhead and manufacturing overhead are used interchangeably. So when we look at factory overhead costs, they're things that cannot be separately or readily traced to finished goods. So they're all considered indirect costs. So they could be indirect materials, indirect labor, and other costs that are not directly traceable to the product. So when we think about indirect materials, they're materials that are used in manufacturing and become part of the final product, but they're not clearly identified with specific product units. So the other thing to think about is direct materials are also classified as indirect materials when their costs are low. So an example might be screws and nuts that are used in assembling mountain bikes, or staples and glue used in manufacturing shoes. So again, that's going back to using that materiality principle that we talked about way back in chapter 1, where we talked about, if it's not a material cost, it wouldn't make sense to break it down and track that specific cost because it's so minor. So that might be considered an indirect material in that case. So we want to keep detailed records on how much we have overall, but we're not going to keep detailed records on how much we use on each individual product. The examples they give here, they show indirect labor as an example, the maintenance people, because you can't directly put it to a specific product, so that's indirect labor. They're working in all departments, doing maintenance on all different departments. Indirect materials, we have cleaning supplies. It's not a part of making the product, but it is necessary to keep things operating the way it should be. And then they also give examples of factory utility costs or supervisory costs. So all of those are going to fall into place also. All right, next we want to look at prime and conversion costs. So we're going to break these down. We can see that the prime cost involves direct material and direct labor. Conversion cost involves direct labor and manufacturing overhead. So prime costs are expenses that are directly linked with manufacturing of finished goods. So it includes both direct materials and direct labor. Conversion costs are expenses that are incurred in the process of converting those raw materials to the finished goods. So it can include both direct labor and manufacturing overhead costs. If you notice that direct labor are costs that are considered in both prime and conversion costs. When we look at non-manufacturing costs, factory overhead isn't always going to include everything. So the things that are not included are going to be expenses that are period costs, and they're going to be recorded differently. They're going to be recorded in the period that they're incurred. So for a manufacturing company, they're also called non-manufacturing costs. So they're recorded as expenses on the income statement when they're incurred. They're expensed as a period cost. Sometimes it's put under selling and administrative expenses, and they're not part of factory overhead because they're not incurred in manufacturing products. All right, so let's look at how these new changes we've seen affect our financial statements. We're going to look first at some of the manufacturing activities that we have. So before we were looking at merchandisers, and they buy the finished goods and then they sell the finished goods. With manufacturers, they are buying raw materials and they're producing and selling those finished goods to those merchandisers. So the main difference is one of them is making it, one of them is buying that finished product. So let's look at how it looks for the manufacturer's balance sheet. So we have different accounts that we're going to be looking at when we think about a merchandiser versus a manufacturer. For the manufacturer, we're going to have current assets of cash, receivables. They're also going to have inventory just like our merchandiser did, but it's broken down into more categories, and that's what we see here. A manufacturer's inventory is broken down into 3 different inventories. So we're going to have a raw materials inventory, a work in process inventory, and a finished goods inventory. And we're going to keep all 3 separate as we track them. So when we first buy the raw materials, they're going to be in raw materials inventory. As we move it into the process of being made, so it's still in the process, it's not done yet, that's going to go into something we call work in process inventory or goods in process. It's also abbreviated as WIP, work in process, WIP. So WIP inventory is where we put it into process, but it's not done yet. And then once it's completely done, then we're going to move it into our finished goods inventory, and that's where we're going to sell it to the merchandisers from. So they're going to carry several unique assets like these 3 inventories, and we're going to keep accounting for them separately. So those are the 3 that we're going to look at. Again, looking at raw materials, it's going to be materials that are waiting to be processed. Again, they can be direct or indirect. Once we move it into work in process, it's partially complete, so it's started in the manufacturing process, but it's not done yet. And then finished goods is when the product is completed. All right, so let's look at what it looks like on our income statement or our balance sheet. What does it actually look like? So we can see what a service provider look like. We had our list of our assets. With a merchandiser, they added in that inventory. And now looking at what a manufacturer looks like, it has 3 inventories. So as I said before, we're going to see a raw materials inventory, we're going to see work in process inventory, and then we're going to see a finished goods inventory. So those are all important to notice. All right, so let's look at now looking at the income statement side of it. All right, so the main difference between the income statement of a manufacturer and a merchandiser are going to be the cost of goods sold. So a merchandiser had the cost of goods that they purchased and then they sold, and the difference was the cost of goods sold. With a manufacturer, it starts out a little differently. So we see that it starts out with beginning finished goods inventory. We add in the costs of goods that we manufactured, subtract out our ending, and that gives our cost of goods sold. So both of them have a cost of goods sold. It's just how it's looked at a little differently. And we're going to get into that to see how manufacturers look at it. So with a manufacturer, we're going to see that we see up in the merchandiser's cost of goods purchased. For the manufacturer, it's cost of goods manufactured, and we're going to have a schedule for that we're going to be preparing. So here's an example of what it's going to look like. So we have a merchandising company here, Telemart, and then we have our manufacturing, Rocky Mountain Bikes. And we can see what their financials look like and how they're a little different. So instead of having merchandise inventory, we start out with our finished goods inventory. And then we have cost of goods manufactured. That gives us how much good we have available for sale, because instead of buying merchandise, we're making it. So it's how much did it cost us to make that new product. We subtract out our ending finished goods, and that tells us how much we actually sold for that one. So same concept, except instead of buying merchandise, we can see that we're making it instead. All right, so let's look at the flow for the activities for manufacturing. So in addition to the income statement and the balance sheet, manufacturing companies are going to prepare additional reports that help managers plan and control the manufacturing process. So for us to understand this, we have to first understand the flow of manufacturing activities and costs. So this slide is going to show the flow of manufacturing activities and the cost flows of those activities. As you can see, the activities flow consists of materials activity followed by production activity followed by sales activity. The boxes below those activities show the cost for each of those and how costs flow across the three manufacturing activities. So there are other reports managers prepare to help them plan and control the manufacturing process. And that's what we're going to be looking at. We're going to be looking at the schedule of cost of goods manufactured. And we're going to do that in the next part 3 video. So we're going to stop here and we'll start with part 3, looking at schedule of cost of goods manufactured.